Following the outbreak of the United States-Israel-Iran war in late February 2026, the Strait of Hormuz has transitioned into a high-intensity naval blockade. The conflict centers on the Strait of Hormuz and Karg Island, where the region's strategic logic has been reordered by kinetic warfare. This is a dual blockade. United States naval forces intercept commercial vessels to enforce sanctions, while the Islamic Revolutionary Guard Corps deploys extensive naval mine networks to deny transit. The logistical impact is immediate: 20 million barrels of crude oil and 20. To calculate how this kinetic conflict impacts enterprise valuation, we use a transmission model. It tracks the flow of economic friction across three specific nodes. Node 1 identifies the physical supply constraints accumulating in the Strait of Hormuz. This physical shock moves directly into Node 2, the macro trap. This represents the stagflationary environment where rising energy costs collide with stalling industrial output. Understanding this transmission mechanism is the only way corporate treasurers can proactively recalculate their capital allocation and risk premiums for the remainder of the year. While Brent crude futures hover around $105 a barrel, physical benchmarks have violently broken away. North Sea dated crude reached $130 and spot prices near $150, driven by a massive 85 million barrel global inventory drawdown in March. The bottleneck is physical. Alternative pipelines cannot handle the volume, and the fleet of very large crude carriers faces profound logistical barriers to any alternative routing. Costs are rising even on trade lanes disconnected from the conflict. Precautionary bookings and bunker fuel surcharges have driven Trans-Pacific spot rates up 40% since February. The energy market is fractured at the physical layer, locking in elevated baseline costs for all downstream logistics. The blockade also captures critical non-hydrocarbon commodities. The region is a primary supplier of aluminum, sulfur, and methanol, all foundational to global manufacturing. The sulfur shortage directly impacts global fertilizer production. This threatens future agricultural yields, creating the conditions for high food inflation in 2027. Simultaneously, the lack of aluminum and graphite is causing immediate operational shutdowns across the automotive and high-tech sectors. This industrial cascade explains the severe contraction observed in the April Manufacturing Purchasing Managers Indexes. This moves the shock into Node 2. For the week of April 27th, 5 major central banks are expected to hold rates steady. Chair Jerome Powell faces a policy deadlock. He cannot cut rates because underlying inflation remains sticky, with core PCE tracking at 3.1%. But he also cannot hike rates to address this energy shock without further damaging a consumer base that is already retreating. The Consumer Sentiment Index has plunged to 49.8. That is a lower reading than the depths of the 2008 financial crisis. Central banks are currently constrained observers. They can neither stimulate growth nor address supply-driven inflation without risking a broader economic breakdown. Using the Fisher equation, nominal interest equals real yield plus expected inflation. 10-year treasuries sit near 4%. With long-term inflation expectations unmoored at 3.5%, the perceived real yield violently compresses to just 0.50%. This near-zero return removes the incentive for long-term corporate investment and rewards extreme capital preservation. There is one significant exception to this investment freeze: the first quarter earnings reports from the largest technology conglomerates. The contrast is stark. While the Atlanta Fed projects U.S. growth of just 1.2%, technology leaders are deploying hundreds of billions of dollars into data centers and silicon. These investments are proceeding despite a much higher cost of capital, acting as an isolated pocket of stimulus within a cooling economy. J.P. Morgan Asset Management has advised allocators to focus on these leaders, who are the only entities capable of sustaining this level of capital deployment. For now, AI infrastructure is operating on a different cycle, largely decoupled from the industrial slowdown. This brings us to Node 3, the macroeconomic roadmap. Given stalling demand and high energy costs, we rule out high growth or low inflation. Plotting $130 oil, 3.1% inflation, and contracting PMIs lands us firmly in the stagflation quadrant. Strategy and capital allocation for the remainder of 2026 must be built on the assumption that this environment will persist. CFOs now face a dual challenge. They must defend the balance sheet while simultaneously funding the technological transformations required to stay competitive. First, teams must stress test margins against a scenario where oil prices remain at or above $115 through year-end. Second, capital allocation must become dynamic. Static annual budgets should be replaced by models that can shift maintenance capital toward AI integration and supply chain resilience in real time. Third, treasuries should evaluate rotating excess liquidity into absolute return strategies or private credit to hedge against the volatility in public debt markets. Finally, procurement officers must treat physical commodities as a primary hedge, as physical prices are now a more accurate signal of risk than futures contracts. Success in the latter half of 2026 will be defined by building a balance sheet robust enough to survive this transition.